What if I told you the secrets to financial success were written nearly a century ago and they are still just as relevant today? In this video, we'll break down timeless principles from a book that has helped countless people build wealth and financial security. The book I'm referring to is The Richest Man in Babylon, written in 1926. It teaches fundamental lessons about saving, investing, budgeting, and financial growth, all through parables set in ancient Babylon, a city known for its wealth, culture, and advancements. And these lessons are more relevant today than ever. Why? Because in Canada, the ratio of income to expenses has worsened, making financial freedom feel increasingly out of reach. If that sounds familiar, keep watching. This book isn't just about managing money, it's about regaining control of your finances no matter your income or lifestyle. In this video, we'll explore 7 core lessons from the book and break them down into actionable steps you can use today. Let's dive in. A story begins with Arcad, the richest man in Babylon. But he wasn't born into wealth. He built it using one simple rule: pay yourself first. Save 10% of every dollar you earn before spending on anything else. This ensures that before paying bills, rent, or groceries, you're prioritizing your own financial future. And here's an actionable step. Set up an automatic transfer of at least 10% of your income into a separate savings account. Don't touch this money for daily expenses. It's there to build wealth, not to be spent. Now, many people think they should start investing immediately. But that's a mistake if they don't have a financial safety net first. Before you invest, you need an emergency fund. Life is unpredictable, job loss, medical emergencies, or urgent expenses can happen anytime. Without savings, you'll be forced to take on debt, which often comes with high interest rates to cover these costs. A good rule of thumb is to have 3 to 6 months worth of essential expenses saved in a liquid, easily accessible account. Only once your emergency fund is secure should you start investing for long-term growth. If saving even 10% feels impossible, it's a sign of an income problem, not a spending problem. The solution is to increase your earning potential by upskilling in a high-demand profession. Choose a skill where your income isn't tied directly to time spent. Example, sales, freelancing, content creation, or building a business. If your expenses take up 100% of your income, the solution isn't budgeting, it's earning more. Savings is the foundation, because without savings, you won't have money to invest, cover emergencies, or take advantage of financial opportunities. Before wealth can multiply, it needs to exist first. Build your savings, secure your emergency fund, and then invest with confidence. Now that you know how to start, let's move on to controlling your spending so you can keep more of what you earn. It's easy to feel like there's never enough money left at the end of the month. But often, the issue isn't how much you earn, it's how you spend it. We live in a world filled with constant temptations. New gadgets, streaming subscriptions, frequent takeout. But financial success isn't about deprivation, it's about intentional spending that aligns with your goals. A common mistake is not knowing where your money goes. If you don't track your expenses, it's easy to overspend on things you don't even realize. Here's an actionable step. Track your income and expenses for 1 month to see exactly where your money is going. Identify needs, essential expenses like rent, groceries, utilities versus wants, non-essential spending like dining out, entertainment. Set limits for each category to ensure you're living within your means. To make this process easier, I've included a budget tracking tool in the description. This file allows you to categorize your spending into essential and discretionary expenses. Set spending limits for each category to avoid overspending beyond what your income allows. Generate monthly and annual summaries based on your actual spending data, helping you spot trends over time. Use color-coded visual summaries to get a quick, at-a-glance view of your household finances, highlighting areas that may require closer attention. By using this tool, you'll be able to identify red flags, adjust spending habits, and redirect money towards saving and investments. Remember, budgeting isn't about restriction, it's about financial clarity. Once you know where your money is going, you can gain control over it. Now that you're saving and managing your expenses, now it's time to make your money work for you. Arcad, the richest man in Babylon, didn't just save his money, he invested it wisely so it could grow. The same principle applies today. Keeping money in a savings account alone won't build wealth. A common mistake people make is assuming that saving alone is enough. But the reality is that returns you earn on your money can make a massive difference over time. Let's compare 2 investment scenarios over 30 years for a $10,000 capital. In a conservative savings account earning 2% annually, after 30 years, your money grows to $18,000, A small gain, barely keeping up with inflation. Now, in a well-diversified investment portfolio earning 10% annually, after 30 years, your money grows to 174,000, almost 10 times more than the savings account. The key takeaway, long-term investing in assets like stock, ETFs, and real estate can massively accelerate wealth growth compared to traditional savings. But before you start investing, there's something even more important you need to do. Investing can increase wealth, but it also comes with risk. Before putting any money into the market, you need to secure your financial foundation. A rule of thumb is that your emergency fund, 3 to 6 months of expenses, should be risk-free, kept in a high-interest savings account, GICs, or money market funds. Only money beyond your emergency fund should be invested. This ensures you never have to sell investments at a loss to cover unexpected expenses. Without an emergency fund, a financial setback like a job loss or medical emergency could force you to withdraw investments at the wrong time, locking in losses. Once you've built your emergency fund, you can start thinking about where to invest your money for long-term growth. If you're new to investing, ETFs are a great starting point. They offer broad market exposure, diversification, and lower risk compared to individual stocks. The key to investing isn't timing the market, it's time in the market. A disciplined long-term approach to investing will always outperform short-term speculation. Now that you understand how to grow your money, let's talk about how to protect it from losses in the next lesson. Saving and investing are crucial, but keeping your wealth is just as important as building it. Many people lose money not because they didn't earn enough, but because they made poor financial decisions, falling for risky schemes, ignoring research, or getting caught up in the hype. Arcad, the richest man in Babylon, warned against reckless speculation. His advice: invest only where your principal is almost safe and where it may be reclaimed if needed. Let's look at a modern example of why this lesson is more relevant than ever. On January 2021, Reddit's Wall Street Bets sparked a trading frenzy in GameStop. Retail investors poured billions into the stock hoping to send it to the moon. What happened? Early traders made quick profits, but thousands who jumped in late saw GME plummet after institutional traders began shorting it. CNBC reported that retail investors lost nearly $10 billion in the process. The lesson: never invest based on hype. Always research before putting money into anything. Stick to long-term, steady growth investments instead of chasing quick gains. The S&P 500, for example, has historically provided an 11% annual return adjusted for inflation. Getting rich is a long-term game, not a short-term gamble. Owning property was a key wealth-building tool in Babylon, and it still is today. However, today we have multiple avenues to invest, including stocks, ETFs, which often provide higher returns than real estate. So the question is, should you buy a home or invest in the stock market? There's no one-size-fits-all answer. It depends on your lifestyle and long-term vision. Stock markets historically provide higher returns than real estate. If you're comfortable with leasing and negotiating with landlords 10, 20 years down the line, then it might make more sense to invest all your money in the stock market instead of tying it up in property. But if you don't see yourself renting forever, then we must appreciate what a home provides as well. Stability and security. You're not at the mercy of rent increases or landlord decisions. Wealth creation. Property builds equity over time, which can be leveraged for future investments. The intangible value of a home. Beyond financials, owning a home provides peace of mind, a sense of belonging, and a place for life's biggest memories. The bottom line: if you love the flexibility of renting and prioritizing stock market returns, that's valid. But if you value stability and long-term ownership, then real estate can be a powerful wealth building tool. If you decide that home ownership is for you, don't rush into it. Buying without proper research can lead to financial strain. Here's an action step. If home ownership aligns with your goals, start researching the real estate market in your city. Assess affordability, and build a financial plan that allows you to buy smartly. Whether you choose stocks or real estate, the key is to invest in something that aligns with your long-term financial and personal goals. Arcad, the richest man in Babylon, understood something that many people today overlook. We won't always be able to work for money, so we must ensure that money will work for us. Whether we like it or not, there comes a point when we either can't or don't want to work anymore. At that moment, the financial choices we've made throughout our lives determine whether we live with comfort or struggle to get by. Yet many people underestimate how much they need for retirement, or worse, they don't plan at all. A lot of people think, I'll worry about retirement later, assuming that government pensions or social security will be enough. But here's the reality. Pension plans alone are unlikely to sustain the lifestyle you desire. The earlier you start planning, the less effort it takes to build a comfortable future. So how much do you need to retire? This is one of the most common questions people ask. The answer depends on your desired retirement style, your expected expenses, and how long you expect to live after retirement. A general rule of thumb is you need 25 times your annual expenses saved up to retire comfortably. So if you need $50,000 per year, you should aim for 1.25 million in retirement savings. That might sound overwhelming, but the good news is compound interest does most of the heavy lifting if you start early. A great example of long-term financial planning is Ronald Reed, a janitor and gas station attendant from Vermont. Despite earning a modest salary, he retired with an $8 million fortune. How? He lived below his means, he consistently invested in dividend-paying stocks, and he let compound interest work its magic over decades. You don't need to be wealthy to build wealth, you just need discipline, patience, and a smart investment strategy. To help you figure out how much you need, I've included a retirement planning tool in the description. It will calculate your retirement goal based on your current expenses. It'll tell you how much to invest per month. It'll show you how long it'll take to reach your target. The sooner you start, the easier it will be to retire comfortably. And now that we've talked about securing your future income, let's address something even more important: increasing your income so you can afford to save and invest more in the first place. If you've been following along, you might have realized something. Every single financial principle we've discussed so far depends on one thing: your income. If your income barely covers your living expenses, it's impossible to save 10% of your earnings or avoid living paycheck to paycheck, have extra money to invest, or build wealth for long term. That means if you still feel stuck after applying all of these lessons, you don't just have a spending problem, you might have an income problem. The hard truth is cutting expenses can only go so far. There's a limit to how much you can save, but there's no limit to how much you can earn. How can we fix an income problem? Learn high income skills. If your salary barely covers your basic expenses, it's time to invest in yourself through time and learn a skill that increases your earning potential. The key is to pick a skill where your income isn't tied to the time spent, like freelancing, sales, software development, or something else. Your goal should be to move away from income that's purely time-based. The bottom line, if you're constantly struggling to save and invest, the solution isn't to keep cutting back, it's to increase your income. You don't need to work harder, but you need to work smarter by building skills that pay more. We've now covered 7 timeless financial lessons from the richest man in Babylon, principles that have helped people build wealth for centuries. As next step, choose one lesson from this video and apply it this month. Whether it's starting to save, creating a budget, investing, or increasing your income. And if this video helped you, like and subscribe for more financial insights. See you in the next one.